Ka-shing family sells empire chunks for cash as crypto slides. Bloomberg reported on May 14, 2026 that the family of Hong Kong billionaire Ka-shing is selling large parts of its sprawling business empire and quickly converting the proceeds into cash. The move, run through the family's holding companies, marks one of the most aggressive de-risking decisions from any Asian billionaire family this cycle, and it is landing in a market that is already drifting lower. Crypto traded heavy as the headline circulated. As of May 14, 2026, BTC sat at $79,223, down 2.2% over 24 hours, while SOL led majors lower at $98.39, down 4.99%. ETH was at $2,247, down 2.1%, and the CoinMarketCap Fear and Greed Index printed 46, a neutral reading that masks a clearly risk-off feel inside spot markets. Family offices step out of the property and infrastructure cycle. The Ka-shing empire spans ports, telecoms, energy infrastructure, retail, and real estate across Hong Kong, mainland China, Europe, and Canada. According to Bloomberg, the family has been working through that portfolio in pieces, putting individual assets on the block rather than restructuring the entire group at once. The aim is liquidity. Cash is piling up at the holding company level rather than being recycled into new acquisitions. The pattern matters because Ka-shing has spent 6 decades pricing cycles correctly. The same family famously sold Hong Kong property exposure ahead of the post-2015 slowdown and tilted into European utilities when those assets were cheap. A move back into cash from a patriarch who is now 97 reads less like estate planning and more like a deliberate call on the price of risk. Crypto reacts as part of a broader risk shift. Macro de-risking from one family does not directly move crypto. The link is indirect. When large Asian capital pools take chips off the table, the marginal buyer thins out across all risk assets, and crypto sits at the high beta end of that spectrum. SOL's 5% drop into the print captures it cleanly. The token has the most leverage to discretionary capital flows, and it moves first on global liquidity headlines. ETH and BTC move together, but with less drama. BTC's 2.2% drop tracks the wider equity weakness Reuters flagged earlier in the session, with stocks shrugging off the latest inflation print but credit and growth. Sensitive assets fading into the close. The 7-day picture adds context. BTC is down 2.21% for the week, SOL is up 2.68%, BNB is up 4.0%, and XRP is up 1.1%. The Tuesday weakness wiped out a week's worth of grind in SOL and left BTC at the bottom of its recent range. For a market that needs fresh institutional buyers to break higher, a high-profile capital exit is the wrong tape. Liquidity signal versus crypto-specific catalysts. Crypto is no longer trading purely on its own news cycle. The same week brought a tokenized money market fund from JP Morgan on Ethereum and Solana, a $120 million Series D for Elliptic, led by Nasdaq and Deutsche Bank, and continued progress on the Clarity Act amendments. None of that was enough to lift price in a session where macro flows turned defensive. That gap between strong fundamental news and weak price action is the part traders should focus on. It tells us that allocators are not positioned to add risk into structural good news right now. They are reading the same Bloomberg tape as everyone else, and trimming. For users who hold crypto on a non-custodial card or earn yield through a staking-linked program, the practical implication is narrow. Cashback and staking rewards do not change with macro headlines. The token denomination of those rewards does. A SOL-denominated 4% cashback program lost 5% of dollar value yesterday before any spend happened. That is the part of crypto card economics that quietly tracks macro days like this one. The shape of the next move, the Ka-shing story, is not a single catalyst. It is a data point inside a broader pattern of Asian capital getting more conservative as the year unfolds. Combined with this morning's print of global money supply at a record $121.9 trillion, it produces a strange split. Liquidity has never been larger, but the largest pools of private capital are choosing to sit on it. Crypto can run in that environment, but only when a clear catalyst forces repricing. Clarity Act movement, an ETF surprise, or a coordinated stablecoin policy shift would all qualify. A neutral fear and greed reading with SOL dropping 5% on macro headlines does not.